Hello and welcome to the 2024 Outlook, Mid-Year Outlook, still waiting for the turn. I'm Michael Urch, Senior Wealth Manager at 360 Financial, and it's my honor to join our President and Founder, Mike Rogers, as well as our Senior Vice President, Brian Bonzak, on this webinar as we lead you through our Mid-Year Outlook. And we also have a new face here. Cameron's our summer intern that's joining us on the webinar today. In 1995, after 5 years working for clients at two of the nation's largest investment firms, Mike decided to start our firm with a vision for providing fiduciary investment management and a customized client experience. Nearly 30 years later, that vision has become a reality as we work with over 1,000 families and business owners to help them focus on both what matters most and on the things that we can control. We exist to enrich lives by navigating and leading our clients through impact financial events and for our clients, building wealth in order to become financially independent, which is that moment when work becomes optional, is one of the biggest priorities, which is really bringing us to the topic of our presentation today on the market outlook. And Mike chairs our investment committee, which has 8 advisors, including Brian and myself. We meet every 2 weeks to examine research on the economy, stocks, bonds, and policy. And this is the topic of our webinar today, to talk through some of what our investment committee has been talking about. Throughout the webinar, please feel free to add questions. There's a Q&A button that should be at the bottom of your screen. If you have any questions, feel free to add them there. We're hoping to make this interactive and engaging. And so we'll answer some of those as we go along. And we do have time devoted at the end to Q&A as well. If you'd like to learn more about 360 Financial and the services we provide, stick around for the end for a couple more minutes, and there will be a survey, 5 questions. If you could take just 2 minutes to answer those 5 questions, we do read that feedback. We want to continually enhance the value provided by webinars such as this, so please take a moment. Before we jump into the investment part of the presentation, I just want to walk through 2 of the areas that we focus on for every client, and I think something that really differentiates us. And we've got this classic Venn diagram. On the left-hand side, we want to focus on what matters to you. And we use an acronym called FORM, F-O-R-M. The F is for family. We want to make sure for all of our clients, we know what matters to you for goals and priorities for family, and that we never lose sight of that. The O is for occupation. We want to make sure that we understand, when is your work optional date? What career changes might you have in mind? Are you going to sell a business? Make sure we never lose sight of those things. The R is for recreation. This is the fun one. What are the things that really help enrich your life that you enjoy doing? And we want to make sure we never lose sight of those. And these first 3, they really make up the why. Why is it that money matters to you? And we want to make sure we understand that for our clients, so that when we get into the money, which is the how, that we can make sure that it's aligned with your priorities. The second half of this Venn diagram is control. We want to focus on what we can control. And we can't control the economy, but we can control how much we research it and think about it and position our allocations with the economy in mind. We can't control the weather. We can't control if tax laws will change. But as we think about what we can control, there's 3 Ps that we talk about here. And the first is our philosophy. As we're looking at all of the elements of your financial life, we believe they should be all integrated, and they should fit together like pieces of a puzzle. And if they're not coordinated, then we'll probably be recommending some changes. The second P here is for planning. Our planning process is 3 steps. We discover, then we design, and then we deploy. And so this is just a repeated process that we go through to make sure that in that discover phase, the form is the most important. We want to make sure that the things that matter to you are captured and never lost sight of. And then, of course, that we design a plan to get you to where you want to go. And that's an ongoing process. We're talking with clients quarterly, meeting with them 1 to 2 times a year, as well as those quarterly conversations. And so that's just an overview of how we work with clients. We focus on the middle right here with the Life Wealth Plan. And so that's a brief overview of how we work with clients. And with that being said, I'm going to hand it over to Mike Rogers to talk more about the market outlook.
Well, thank you, Michael. That was a great overview of kind of the services we provide and the why are we in business. You know, like Michael said, I started the firm up 30 years ago, almost 30 years ago next fall. And it's hard to believe how quickly 3 decades go by. What I love most about those 3 decades is to watch people grow to hit their financial goals, watch the organization and the people here on our team that are supporting our 1,000+ clients, how they can grow. And so it's really important for me that we have the sense of a culture and the sense of a being and a purpose that's all around us, enriching lives, like Michael talked about. So today is a fun thing to do because we get to talk about what happened the last 6 months compared to what we thought might have happened back in January when it was winter and it was cold, and now we're here on a beautiful July day, and we can look back in hindsight. And so one thing that we had talked about at the beginning of the year, and we're still expecting, let's focus on what's going on in the economy. So I'm just going to go through that, the agenda. We're going to talk about what's going on in the economy, what's going on with the equity markets, what's going on with the bond markets, and what we anticipate there. The big, kind of elephant in the room is the election coming up in November. How does that impact the markets and what to expect from that? So we'll cover that a little bit as well. And as Michael said, any questions that you have, throw them into the Q&A chat. We'll answer them on the fly if we can, or we'll do it towards the end of the program. So let's look a little bit at the economy. The economy has done very well this first half of the year, but it is starting to slow down. And we think that's going to continue. We'll talk about interest rates and bonds a little bit later, and everybody's been talking about how they want rates to go down. Then one reason rates will decrease is if the Federal Reserve not only sees inflation coming down, but also they see growth of the economy coming down. So it's almost one of those be careful what you wish for. If you have aggressive rate cutting by the Fed, it potentially means that the economy has slipped into a recession. Okay, so it's okay that we don't have aggressive rate cutting. As a matter of fact, we thought rates might be cut, starting in the summer when a lot of the experts thought it was going to be in the spring. And now it's looking like it might be here in the fall, maybe as early as September, but I'll get into that in a minute. And the reason that we're looking at the economy is because that's the driver, that's the engine of it. And there's a couple of things here that are really quite interesting, I think, on these two charts. And it's home equity. And so if you look at the equity extraction from refinancing, in other words, people taking loans against their house, let's be honest, that's what a home equity loan is. It's what we used to call in the day a second mortgage, against their house, using that money and they're spending it elsewhere. It could be on improvements on the house. It could be buying another house. It could be going on vacations, but where was that money being spent? And what we found is that if you look over here on the right-hand side, money was coming out of home values, mostly because people were spending so much money on improving their homes during COVID and shortly thereafter. And that's what caused a big inflation bubble in the first place, was this huge demand uptick. Okay. But the benefit of that was that when people were taking those home equity loans and then they were looking at kind of their mortgage rates in general, they were at very low levels. And so there's a percentage of personal income, we've seen that these numbers have dropped quite a bit, which is a positive. On the refinancing activity, which reached its high in 2021, you can see now that's almost non-existent. So people can't refinance right now. As a matter of fact, in the housing market, one of the problems that we do have is people don't want to give up that very low interest rate, because if they move, it's going to be double at least what they might be paying now in interest. And now, so that's created, this low inventory levels that we've seen. And so people are not refinancing, of course, because the rates are higher than they were before, which also means they're not taking money out of their homes to use for other spending. This will, in fact, slow down the economy. And so that's part of the reason that we'll see a little bit of a slowdown here. And when we look at the government and the control over the Federal Reserve on the economy, the more interest rate sensitive that the participants, all of us, are within the economy, the more effective the Federal Reserve can be with lowering and increasing interest rates. But a growing percentage, as we show over here on the left, of households actually don't have mortgages, or they have a very low fixed rate mortgage. But look at how this blue line is represented with people that just don't have a mortgage at all. They don't care if interest rates are 7.5% on a mortgage or 3% on a mortgage when you don't have one. This dark blue area predominantly are a lot of homeowners that have those 3% or maybe lower mortgages. Okay. And then, of course, this doesn't add up to 100% because from a housing standpoint, we have a chunk of people that are renting. And there's a new term that's, they rent on basically on purpose, because that's what they prefer to do. Preferred renters um, are getting impacted a little bit by inflation. Okay. But when you have a huge group of people that are renters, they don't necessarily care about mortgage rates. And you've got a large group of people that don't have mortgages. They don't really care too much about mortgage rates, and nor does the homeowner with the 3% rate. So you can see one of the challenges for the Fed is they just don't have as much control over some of these impactful rate increases or decreases like they might have had in the past. Okay. So, and we know that refinancing does provide, a lift for homeowners. And so what we're looking at here is a slide that basically says when you look at different times of recessions and we look at consumer debt versus mortgage debt, you'll see that mortgage debt has dropped dramatically. It's picked up here a little bit here on the right-hand side, and so has consumer debt starting to pick up a little bit. Okay, so we are looking at these trends of these pickups because as debt service ratios go up, more people are spending more money towards their disposable income towards debt. That also slows down the economy because you just have less to spend elsewhere. So here is actually a little bit of a situation where, between hybrid work and low mortgage rates, homeowners have been able to put more money into their pockets or to spend more money, but we're starting to see that turn a little bit, not drastically, but a little bit over on the right-hand side of this chart. Okay, less spending because we're still in the economy that is driven by consumers. Less spending by consumers will probably slow down the economy. Now, we're not calling for a recession in 2024. We actually did not call for a recession back in 2023 when I think everybody in the world was calling for a U.S. recession. We thought that we would get through, and we did. But if this growth continues to slow down and debt service continues to go up, that's something we're going to be keeping an eye on at our investment committee meetings.
One of the things that the whole homeowner situation makes me think of with our meetings as well is that most homes aren't being sold because people have those low interest rates. And so there's an opportunity right now where home building is one of the ways that you can add supply. And so, it may make sense to have more in that home building category for that reason, as well as others. And so it's just another element of how this impacts how we think about the investments.
Mm-hmm. Absolutely good point. And so when you look at home builders and the products that go into a new home, there's still a lot of opportunity there because of this lack of inventory. Yep. Thanks, Michael. Yep. Absolutely. The other thing that's happening a little bit is labor costs are starting to come down. Okay, and part of it is because unemployment is starting to pick up a little bit. Not a lot, just a little bit. And remember, 6 months ago when we did this, 7 months ago, we talked about watch unemployment. If unemployment starts to really increase, that's going to be a sign that we're going to have a recession. And because we've never gone into a recession when unemployment's been decreasing. So let me say that again. We've never gone into a recession when unemployment is decreasing. So unemployment tends to give us a little bit of a leading indicator of where the economy is going to go. And right now, what this chart is showing is that labor cost, which plays a key role in inflation and has been pretty sticky. And that's why inflation has been reluctantly coming downward slowly. But we're starting to see this decrease. We're starting to see labor costs starting to actually come down a little bit. And that should take off some pressure off of wages and salaries, and a cooling labor market, is a good sign for easing of inflation, which hopefully leads into getting closer to the target rates that the Federal Reserve would like to see of core inflation of about 2%, maybe 2.5%, by getting some of these labor costs down. Okay. And you just remember, I think it was 6 months ago, maybe 12 months ago when we were doing this, we had this whole, lots of turnover, lots of people leaving jobs and going to different jobs. We're seeing less of that now. And that's another reason why the labor costs have come down. we do expect that rental prices for apartments specifically, maybe single family homes, will start to come down a little bit as well. And as demand cools there, you get a little bit better inflationary trend as well. And so, this is specifically here looking at housing as far as core inflation versus ex-housing for core inflation. So you can see that this black line is showing how high core inflation was. Remember, we hit basically almost 7% of core inflation back in September of 22, and we've been trending downward pretty much ever since. We had this little trickle upward, but you can see it's starting to come down. So this follow the black line. That's exactly what the Federal Reserve has been hoping for. That's what the turning of the inflation number is what we're looking at. And then you'll see over here on the far right side, the more recent data of core services housing actually has dropped almost to zero as far as an inflationary number. So if we can get housing, which is rental prices, to come down, and we can at least stop going up, and maybe at a slower pace, we'll take that as well. We're starting to see all the reasons for inflation to kind of stay in these low levels, and maybe make its way towards, instead of 3%, maybe make its way towards 2.5% sometimes next year. Core inflation, to put in perspective, a year ago was at 4.65%. 4.65. Now we're at about 3.25. So it's a dramatic turn of events as far as the inflation numbers are concerned. And some could argue, was it because of all the work that the Fed did, or was it because the businesses took care of the problem with the supply chain? In the supply chain, if you remember a year ago, especially 2 years ago, was so bottlenecked, and with all the demand for goods that people were expecting, it created that inflation jump. But between the two of them, we'll never know what actually was the result for this downward trend, but both of them probably impacted it, is what it really comes down to. So this chart is showing a lot of economic forecasts, and basically it's just looking at GDP up here at the top. And I'll just focus on a few of these: year-over-year inflation and GDP, and then maybe some interest rates. So real GDP is, here in the blue box, Q2 2024 came in at about 2.2%. Q3, these are estimates, but this is what we're expecting as far as a forecast. A Q3 of 1.4, Q4 of 1. So we end the year of a growth rate here in the U.S. sub 2% at this 1.8% number. This seems like a fairly logical trend that we're seeing, and you can see that it's substantially less than what we had in 2021. Remember, the economy grew quite strongly. Again, one of the reasons we had so much inflation in 22, because the economy snapped back so quickly from all the stimulus money that was provided in 2020. Okay. We slowed down a little bit in 2022, and then we, kind of picked back up in 2023, and then are flatlining a little bit from that number here in 2024 as far as expectations. So I heard maybe Brian or somebody maybe saying something, or was it Michael? No? Okay.
I wasn't, but I was just thinking about that Fed funds rate. If you look at the annual numbers there, just the dramatic change from 2021, when that stimulus sort of ended and they started increasing rates, just to see it went from 0.25 up to 5.5%. And we have some charts on the bonds later that it's just good to keep in mind how quickly things were increased in that time period.
Yep. Yeah, absolutely. That's a huge jump. And so if you're in bonds or bond funds, you felt the impact of that, didn't you? Because, as rates were spiking upwards, your bond prices were dropping. Now kind of have a little bit of the opposite, not nearly as dramatic, but as rates go down, that's usually good for bonds and bond funds, because the price of those bonds increase in value. But that was pretty dramatic. Also look at, sorry about that. I hit my wheel on my mouse. CPI, was at 4.7 back in 21, spiked up to 8, and now we're thinking we're going to be sub 3. So that's a pretty big change, of course, as well. The prime rate, a lot of people ask us about prime. Basically, take the Fed fund rate and add 3 percentage points on. That gets you about the prime rate, which tends to be the rate that banks loan to customers at. So it's a little sticky, as you can see. It's not. It was at 3.25 back in 21. 3% plus 0.25% gets you that prime rate, and now we're sitting at about 8. So a little bit of a decrease in interest rates is what we see coming. Let's focus on the stock part of the market now, and we'll wrap all this together, equities and in the economy and bonds here next. But stocks have really pulled forward. At the beginning of the year, we were thinking stock market returns could be around 10% on the S&P 500, and year to date, as of yesterday, the S&P 500 is 17.78%. Okay. What this chart is showing you is just kind of an interesting chart, I think, from a perspective of looking at history. So let's go all the way back to 1949, and believe it or not, back then it wasn't the S&P 500; it was the S&P 90. But nevertheless, the S&P 500 started in 57, and when a bull market is approaching its second anniversary, like we are now, and we've gained about 55% returns since this bull market started, which seems like a lot, but it's actually a little bit short of a 2-year bull market. And so this chart is just showing when we go into a bear market and then we come back out of it, an upward trending market, whatever you'd want to call it. On average, the next 2 years that bring about a 60% return on the S&P 500 over that 2-year time period. Okay. Now, if you take out 2009 and 2020, which were extreme recovery years, especially because we had a COVID pandemic that was very short-lived. But remember, stocks went down a lot. And then in 2009, we had the Great Recession. So the two extremes, you're still sitting at an average, this gray line, which is sitting at about 55%. So we're right about the average, frankly. Okay. So based solely on this analysis, stocks may not and probably can't deliver the same upside that we've just experienced for the last year and a half, because we've snapped out of this low level of market performance in 2022. So we're telling people is it's great that we've got the 17.78% in the S&P 500, but of course we pretty much have hit the average as far as what you would expect after a 2-year time period when the markets drop. Okay. So, there might be some more volatility. We'll talk about that a little bit as well. And that might come up with the election, might come up with some other issues going on globally. But volatility probably will show up a little bit more in the second half of the year than what we had in the first half of the year. So, and the other thing I want to point out is let's put the S&P 500 in perspective. I put down a couple of numbers here, so let me make sure I got these right. Dow Jones, which is 30 stocks, is up 9.24% through the 17th of July. The NASDAQ market, which is mostly technology companies, is up 21.5%. Okay. So one thing we talked about the investment committee is let's just focus on the S&P 500. It's 500 companies in the United States. It's market cap weighted. So what that means is the biggest companies get the biggest impact on the returns. Okay. Everybody's heard about NVIDIA stock and how well that's done. Okay. Believe it or not, out of this roughly 18% increase in S&P 500, of 500 stocks, one of them, NVIDIA, made up about a third. Okay. So when you look at the Dow Jones Industrial Average, or maybe you look at some quality portfolios that don't own NVIDIA because they pay dividends, and we have one in our account, they're not keeping up with the S&P 500 if you don't own that one NVIDIA stock. So 499 stocks performed at the 2/3 return level, and one stock gave it the extra 1/3. So that's something that probably is not going to continue either. It seems a little bit to me, I know this is not a word, bubbly. It's a little frothy, from that standpoint. Michael or Brian, do you have any other commentary on some of the stock market performance of late?
Yeah, just expand on that, what you just said, Mike. It's the breadth of the SP 500. Like you mentioned, we have one stock, NVIDIA, that's really leading most of the gains. So we're looking for is what they call a rotation into those other 499 or a larger portion of the SP 500. And we might be even seeing that right now over the last couple of days. We've seen NVIDIA and some of the tech stocks sell off, and they're moving into some of these quality companies that are mainly maybe in the Dow or household names that we've heard that have been underperforming for over the last 18 months. So stay tuned. I think, and that's a good sign. We want breadth. We want more participation on the upside. We don't want to hitch our wagon to NVIDIA and a couple other stocks because that's not diversification, and that's a risky proposition for investors.
Yep, absolutely. Absolutely. And seeing that spread out a little bit, even among different types of stocks, it's been really driven large cap growth. Remember, large cap growth, the NASDAQ market that I mentioned was up 21%, was also the market that was hit the hardest back in 2022.
Yep.
So maybe we'll get some more participation out of small companies, maybe a little more participation out of mid-sized companies. We still don't, as an investment committee, we still are underweight, the international stocks. There will be a time where they'll have their day in the sun. But we've been okay with being underweighted, and it's helped our portfolios by not having as much in most of those international markets too. So thanks for that input. The other thing that's interesting, when we go back and we look at times when times when the Federal Reserve has increased interest rates and then they stop. A lot of times we'll focus on what happens to bonds in that environment. We'll talk a little bit about that in a second. But what happens to stocks in that environment? And so this is the time of pause. And right now, the Fed has been almost a year, 340 days, since they last raised interest rates. I think it's 345 actually at this point. Okay. So this is the second longest time in quote unquote modern market history that it's been this long that the Fed has done nothing as far as raising rates or lowering rates. But we're specifically looking at this pause period. And the S&P 500 during this pause period, when you go back through a number of different situations, really sees quite impressive S&P 500 returns most of the time. The only time we didn't see that was back in 2000, 2001, when the Fed paused, and the S&P 500 actually lost 7% during that time, mostly because we went into a recession. And if you might remember, we had some accounting scandals, with some of the firms that were out there, think Enron and some of the big accounting firms. Plus, we just had the big, the dot-com bubble that burst, but generally speaking, we're pretty much in line with what happens when the Fed goes into a pause. And so I think from the standpoint, that also gives us a little reflection on, okay, we've done very, very well here. We're not market timers. We're not trying to predict, which way the market's going to move tomorrow. But I think it is a scenario where we say, you know what, just looking at this, it would tell you that, if monetary policy kind of continues and they start decreasing interest rates, maybe we've seen already a lot of the market movement already, as far as stocks are concerned. So what's really going to drive the market to go higher, if it does go higher, it's going to be corporate earnings. And that's almost always the case. Earnings are what drive stock prices. It's always logical. It's like, well, if a company makes more money, they should be more valuable. And if they're more valuable, the price of that stock should go up. And so LPL and a lot of other investment firms, and remember, we get a lot of this data from our partner LPL, who's our custodian for our accounts. They've raised in their market research department the expectations for earnings. And at the beginning of the year for 2024, we were looking for $235 in earnings. It's now $200 in earnings. And then next year, $260 in earnings. So, corporate America has emerged from the earnings recession. And, now 6 months later, when they started, not only are we seeing good earnings, we're seeing accelerating earnings from a lot of companies. And part of that is because, supply chain is normalized. Part of it is because everybody's talking about AI, and that is a real thing. That is what's driven NVIDIA stock. NVIDIA stock isn't going up like the old days of .com where everything was going up in price and there was no earnings. big reason Nvidia stock is going up so much is because their earnings are going up so much. So again, is it ahead of itself? I don't know. And that's today's topic isn't around that. You can talk to your advisor about that, but it is a scenario where its earnings are pushing up the stock price and everybody's expecting higher earnings down the road. So if we have growth rates of 8% and 10% over the next couple of years, that bodes well, obviously, for the stock market. So what we're telling people generally is the stock market looks to be kind of, as far as valuations, elevated, especially relative to bonds. And this chart here is just saying that, when you look at equity premiums and the risk that you're taking, right now we're at a fairly high amount of risk in the market because the price to earnings ratio is around 21. So the price of the S&P 500 divided by the earnings numbers that we just went for estimates is sitting about 21 next year's earnings. The average is typically about 17. So that's why when you look at the valuations, this chart's a little bit inverted. It's saying basically, the prices versus bonds where we can get some pretty solid yields might be a little bit ahead of itself, a little, if you will, frothy because of that higher PE ratio. And so a lot of this, when we're trying to predict the stock market, it's very hard to do, but it does look a lot of like the good news as far as lower interest rates coming somewhere in the future, earnings being surprisingly good has been a little bit baked into stocks already, and hence the 18% return out of the S&P 500 for the first half of the year. So anything on the stock part, you guys, that I did not cover that you think might be helpful for our clients?
No, I think you kind of touched on a lot of good stuff there, Mike. I think next topic, talking about the U.S. election, I think a lot of corporations are sitting and waiting to see what happens so they know what their expectations are with regulatory things, tax return, tax rates. And so they can make some good decisions with their resources. Every corporation is a profit corporation. They want to, do well for their shareholders. So they are maybe sitting on their sidelines a little bit, waiting to have this issue with the election cleared up so they can move forward with their strategic plans, their business plans. If they're going to hire people, they're going to build plans and things like that. So I think and those strong earning numbers, I think, is also something I've been watching very closely going forward in 24 into 25, so we can support higher pricing and higher stock pricing.
Yep. Yeah, absolutely. In this election, we always hear about it, right? Every 4 years, this comes up. Every 2 years if you're in Congress, but every 4 years it comes up, and we have obviously a big election coming up, and we do think the election creates a lot of noise. It can create more market volatility. One reason maybe the NASDAQ has had some troubles here the last couple of days is because of some rhetoric that's coming out of, kind of both parties as far as being tough on China, therefore being tough on some of the technology areas, and how does that impact Taiwan and therefore semiconductor manufacturing. So those are the sort of noise factors that pop up. So what I thought would be helpful is let's take a second and just look at, and you guys is here on the webinar have seen similar data from us in the past. We talked about this 6 months ago. But what happens to the stock market, whether there's a Democrat or a Republican sitting in the White House? And so what's interesting about this is it shows kind of a few different areas. Let's look at the S&P 500. We go back to 1950, so a pretty good sample range. And down here, what we have is when there is the control of Congress. Okay, so when we have a Democratic president and we have a Republican Congress, which means they have control of the Senate and the House, the entire House of Congress and the Senate, we get returns of about 16% on average. Democratic president with split between the Senate and Congress, we get about 15.7%. So very solid returns. When we have one party that has control over everything, whether it's Democrat, here in this case, the returns dropped almost in half. Okay, same thing over on the right side. So we got a Republican president, and we have a scenario where the Republicans have control over both parties. We have substantially lower returns than what we have when we have a split between the Senate and the Congress with a Republican president. So generally what's best for the country is political stability, of course, is one. And political stability is created by checks and balances. And so checks and balances is what the whole country is built on. And that's when the stock market tends to do the best. So that surprises a lot of people. Whether you sit on the right side or the left side of the aisle doesn't really matter. What matters is that we have a functioning government that has some checks and balances in it. That's what the stock market tends to like best. I thought this was a really good chart that we received out of the LPL research department, and it kind of shows the impact of what can happen in Washington when you're worried about which party is leading the country, if you will. So if you are so inclined, say, I'm only going to invest my money when there's a Democrat president or a Republican president. Again, we're not making a political stance here. We're just looking at data points. So if you took $100,000 back in 1950 and you just run that basically through the end of June, $100,000 when only invested when a Democrat was in office, and I got to make sure I get my numbers here because the chart over on the right gives you some data points, but when only a Democrat was in office, your $100,000 grew to $3.12 million. That's pretty good, when you only invested when a Republican was in office, it grew to $1.04 million. At the end of the day, if you said politics don't drive the portfolio that I'm going to invest in, when I'm going to invest, I'm just going to keep my money invested. And this is day in and day out, and it's all in the S&P 500. So it's not real diversified, but you get the point. You just follow through this time period. Your $100,000 not only surpassed the $3 million and the $1 million mark, it grew to $2 million. And that's reinvesting dividends and everything else back into the portfolio. But look at the substantial difference. So, what we've been telling people, especially, and I've been telling people a lot of times is, let's not have this election come into our thought process around how we're investing our money for those form goals that Michael was talking about earlier. Will it create some noise? Will it create some market volatility? Almost for certain. But I don't think we want to make drastic decisions on our investment strategies. You certainly don't want that from your investment committee. And you don't want to do it, we don't think, in your portfolios either. So that's such a powerful slide. And frankly, pretty surprising that's that dramatic of a difference. Okay. So how about bonds? Let's look at that a little bit. Bonds are providing income again. Just a couple of years ago, bond was paying you 1%. Now it's paying you 4%. Tax-free, 5, 6, depending on what type of bond, maybe 7, as far as the actual coupon. And the coupon comes from the old days when you used to get a piece of paper that was a bond that was issued by the government or by a corporation, and you would cut off the coupon and you would take it to the bank, and that's how you got your interest. Obviously, we don't do that anymore. But those coupon rates, as they're still called, have gone up now, where you can actually get some very good income out of your bond part of your portfolio. And what this chart is showing here is, if basically as interest rates start to go up and go down, you can benefit by the yields changing. But you can also now benefit just by the fact that if interest rates stay neutral, they don't drop dramatically. You have a scenario where your bonds and your bond funds can make you some pretty nice returns over cash, potentially. There's always more risk in bonds than cash, and as far as the money market is concerned, and definitely over where we were a couple of years ago when rates were down here, at this zero level. So we are expecting Fed fund rates to decrease slightly over the next, probably 3-4 months, maybe more so next year. Remember, again, I talked about being careful what you wish for. Fed fund rates start to really drop drastically like we had back here. That's a sign that the economy is in real trouble. That's good for your bonds, but might not be as good for your stock part of your portfolio. And hopefully we are getting back to that correlation, or that negative correlation kind of between the two, that helps out with the diversification in the portfolio and manages the risk a little bit better. Okay. So, as we've seen through the years, with interest rates, the 10-year treasury is right now at about 4.17%, I think is the number it closed at yesterday. we're kind of looking for it to get maybe down to 3.75 to 4% sometime this year yet. That will be good for your bond funds, and it's also good for your portfolio to have those better yields. And part of it is we're still a little bit of ways away from that 2% inflation number that the Fed really is hoping to get to before they drastically cut rates. Brian, is there anything you want to talk about on rates? Because you follow that on the investment committee for us.
Yeah, and there's a couple good slides coming up too, but I think Powell did come out, and that's the chairperson of our Federal Reserve, and he's kind of hinted to a crowd, not officially, but he said maybe we are able to cut rates before we get to 2% inflation rate. If he sees the trend, we'll be supporting that. I think it kind of goes back to some of our inflation slides. If that downward trend happens, he may pull the trigger on it a little bit sooner than actually hitting the 2 before we see rates go down. And I just think if the economy can stay strong and employment stays low, and consumers are still out there spending money and they're keeping their jobs, yeah, he doesn't have a lot to be concerned about, because he's not pushing this economy into a recession if it kind of plugs along at that 1 to 1.5% GDP number. So it'll be interesting to watch what happens here over the next. He's got two more meetings before the election, and then one after the elections, or 2 after the election, excuse me. So he's got a window here of 2024 to make an impact going into 2025. So we'll get to some other bond funds or slides here in a couple more. So
yeah, this is the one that we have in here that we use. This talks about the largest contributor, and maybe just grab this one, Brian, if you want. When we look at bond returns, most of it comes from from the actual bond coupon,
right? Yeah. Pricing of a bond, yes, can go up and down based on the which way interest rates are moving. If it's falling, bond prices go up. If rates are going up, then the bond prices fall, which we experienced last year in 22. But yeah, we're more interested in collecting the dividend, or collecting the interest and the income from these bonds. So
yeah, and that's kind of what this chart is showing is I think it's 90% roughly of the returns of a bond really just come from the coupon. And right now, what we're saying, just to simplify it, is the coupon, the rates are good, from a perspective. And if you're owning bonds and rates start to go down, maybe you'll get a little bit more price appreciation, that 10%, but at least you, quote unquote, locked in that higher yield on that bond.
Yep. Right.
Okay. So, and I mean, we've covered in summary what we wanted to cover from the perspective when we think stocks are probably highly valued at this point with the 21 PE ratio. It doesn't mean that they're going to drop dramatically. If you do have some cash, you talk to your advisor, make sure first it's sitting in a money market account that's earning about 5% interest. And we have one that we use that does that for us, and it's got daily liquidity to it. If you're nervous about the markets, and we do get a little volatility, maybe there's some opportunities if the markets sell off like we had yesterday. The NASDAQ went down quite a bit. The Dow Jones was up. So it's hard to, where do we invest in those different areas? But, talk to your advisor about money sitting on the sideline and when to get it into the markets. Because the one thing we don't want you to do, get so enthusiastic or get so worried about the fear of missing out, FOMO, that you just say, okay, throw everything into tech, large cap growth stocks. I've been doing this long enough. I remember that happening back in 2000 when everybody wanted to buy the .com stocks. Again, I'm not saying it's the same time period. That was a whole different business model back then for those .coms and what we're seeing now. But, talk to your advisor about what would be a good strategy for you. The 5 years, 10 years, 20 years down the road, it might not really matter if you invest today or if you invest next month. But just from a standpoint of watching the volatility, that might be something you want to take a look at. Okay. We still tend to favor large U.S. stocks, right? When we get to the investment committee meetings, that's mostly what we talk about, and less international.
Nope. And I think if interest rates do come down, then, we talked about the mid cap and small cap stocks are a little bit more interest rate sensitive. So if they do get some relief on some of their carrying costs of their interest costs of their loans and debt, then those companies could do well here going into 2025. So we do have a portion of our portfolios, focus on those small cap, mid cap stocks.
Yeah, and those are interesting because those small mid cap stocks, I get, for a better word, I guess, struggled kind of the first half of the year. for most
Yep.
of it, up till about the last couple, 3 weeks when some of the inflation numbers came in lower than expected. And therefore the thought, well, the Fed's going to cut rates sooner than expected. And so small companies had a nice little push up. Again, there's more risk in small companies, but they do trade. They're trading now at lower priced earnings valuations. So there's probably some opportunities there as well.
Yep, some value there. Yep.
Yep, absolutely.
One
Michael,
of the dynamics
how about you?
that, yeah, one of the dynamics I think is interesting as well. We were talking about a money market fund making about 5%. Bond funds are getting a little bit less than that in interest, but as we're looking at interest rates, economists aren't expecting them to be increased. It's likely that by the end of the year, they'll come down a little bit. And the mechanics are a little different on a money market compared to a bond fund, where if it goes from 5% interest to suddenly offering 4.5%, a money market fund can change that as the rates are coming down, and then you just have less and less income that you can make. But if you're in a bond investment, you'll at least get some increase in the price of in capital appreciation if those rates come down. And so, I mean, I really think if you're sitting on a bunch of money in cash in a money market that you don't need in the short term, now is not a bad time to evaluate at least a bond strategy if you feel very conservative, or, I mean, really talk to your advisor about overall. A mix of stocks and bonds could be good as well. But particularly because we think we're at a high point with rates, and there's, I mean, broad agreement on that. I don't think anyone's expecting rate increases. It's not a bad time to consider getting more of that to work.
Yeah, absolutely. Kind of gets back to, this, probably this chart, just it doesn't really reflect too well here in this chart. But, most of your return over the years usually comes from that coupon. The coupons have gone up, but Michael, what you're saying makes a lot of sense. If rates go down, you also get a little price appreciation, which helps out in these sort of markets as well. Without getting into a lot of details, bonds trade at $1,000. That's called the par value of a bond. And a lot of bonds, when they come out, they trade at $1,000 when they're issued, if you will. A lot of bonds are trading below that. So those bonds are going to make their way, unless they default. They're going to make their way towards maturity. Then therefore they'll make their way to $1,000. So they yield to maturity. You could get a better coupon, and you get a little price appreciation between the discount they're selling for now and the par value that they hopefully get to somewhere down the road. So talk to your advisor about that. It gets into a little bit of the complications of yield to maturity, yield to worst, and coupon rates, but it's very important, and it can make a big difference in a portfolio. If you make 5% in the money market, that starts to decrease on you versus 7% in a bond fund, because you get a little total return in there as well. Again, it's all hypothetical. It doesn't mean it's going to actually happen going forward. I always have to reference that. There's no guarantees, but it just seems logical that we're kind of set up for that sort of environment right now. So from a Q&A standpoint, I know I've seen a little bit come in here, but do you guys have any Q&A that's top of mind that we should be discussing that's popped up on your screens?
I don't see anything specifically on my screen, Mike, so maybe you have it on yours.
Okay. So I see one thing that just talks a little bit asks about international. And so international is still a very volatile area. Believe it or not, interest rates are lower in international markets than they are here in the US for a couple different reasons. One of it is because we've been more reluctant to decrease rates, and we're starting to see them go down in Europe. Certain area of international stocks that might make some sense, dividend paying companies, that are good quality companies with good earnings, but we're still very, very underweight that international exposure. Emerging markets looks cheap. It's looked cheap for a year, for 3 years, for 5 years. So we're not big fans of emerging markets right now. And the biggest emerging market is still China. China's got a number of issues going on. Their birth rates have stopped going up. Their population is decreasing. They got literally trillions of dollars of debt that they've used to build out major cities that nobody's living in. And they're building electric vehicles at very low price points. But most, especially of Europe and the Western countries like the US, have put large tariffs on those to neutralize that discounted pricing. So we're not a big fan of that. Maybe there's some more opportunities in India or some of the other Asian markets, but we're just for the most part staying out as of now, staying out of those international markets, and of course that could change, but that's why you want our investment committee to get together every week and every other week and evaluate that. I got another question here about gold. Gold prices have been up this year, of course, so is copper. Copper goes into electric vehicle manufacturing of batteries, and so that's one of the reasons. Gold is something that we have at one time owned in the portfolios. It helped us out nicely during the pandemic. We owned it before the pandemic, and it performed well during that time. But we currently are not a big fan of it. It's gone up a lot. Remember, gold doesn't pay a dividend. Gold doesn't earn any interest. You're just basically buying it on speculation that somebody later is going to pay you more for that commodity than you paid for it today. And that can be okay, especially when the markets get really nervous. We saw gold do pretty well yesterday with some sell-off in the stock market. But generally speaking, the price of gold has done well, but actually the price of stocks have done better. So I think just by having less exposure to gold here recently and commodities in general, probably helped us out a little bit in the portfolios. I think that's all I see for questions on my end.
I had a question coming on. Oh, go ahead, Michael.
I was just going to say, I see a question that's asking for thoughts on cryptocurrency.
Does anybody want to take a stab at this one?
Yeah. I mean, I think with cryptocurrency, and I would say we view it more in the speculation category, because there's not a lot of financial cash flow or other things that companies have when we're looking at investments. And so really the question is, do you think that people will think it's more valuable than it is right now, just because that's what people think? And so I would say we're very cautious with cryptocurrency. And that would be my comment. I don't know if Mike or Brian, you would add anything to that.
I agree. There's a lot of unregulated, surrounding the crypto. Washington, D.C. could just, make a change to that and cause a lot of impact on the crypto side. I think the blockchain technology is here to stay, and it's going to be very powerful, and we're going to continue to see that be influencing other parts of our economy. But the actual Bitcoin or the other cryptocurrencies, I think, it's just way too volatile for most of our investors.
Mm-hmm. Yeah. With that being said, I mean, it's done well, but there's times where it's been just a horrible investment as well. So, and I use the word investment lightly. It is very, very speculative. And Michael, you pointed it out. I mean, it's the most speculative hope that somebody in the future is going to pay you more for this digital coin than what you paid for it today. So I think we've covered the currency issue. See another message. Here's one from Jim. What's the average duration on the bond funds in your core portfolio? And do you expect to make some moves in that regard? Good question. The average we've got, in our core portfolio right now, we typically have, again, it depends on the risk that we're looking at, and depends on whether it's a tax-free type of bond fund because it's a taxable account, or an IRA that doesn't need the tax-free bonds. But we generally have three different strategies in our bond part of the portfolio. Convertible bonds tend to be mid-range in duration, usually about that 5%, 5-year to 7-year range in duration. Then we have a shorter term bond fund that tends to be more geared towards that 2 to 3 year maturity date. And then we have an intermediate bond fund, which is a core bond fund that we utilize in the portfolio that tends to run about 7+ years of duration. So Jim, to answer your question, what we're doing there is we're basically spreading out the risk among different durations. We're looking at, do we go a little bit longer in duration potentially on some part of the portfolio, but the strategic income fund that right now is shorter in duration can go longer if they see it being appropriate, but it's been short for a while, and they tend to continue to do so. So to answer your question, the duration, if you blend those three together, it's probably about 5 years, between the three different strategies that we're utilizing. Our bond funds that are more geared towards muni bonds, and we tend to like municipal bonds in the state of Minnesota because most of our clients are tied to Minnesota income taxes. Not all of them, of course, and we'll customize it there. But that tends to be a little bit longer in duration. But because we need a little bit better yield from that part of the portfolio to make up the tax-free part of the return. But even that's maybe 6 to 7. So we're not going out 20 because that's a very volatile end of the yield curve, but we're mid-range. So I think I answered that one. Any other of them come up here?
I don't have any others on my screen.
Nope.
Okay. So let me do this, and let's shift gears for a minute. And a lot of you on this webinar today are not current clients. So when we talk about our current bond portfolio and what the duration is, that might not impact you directly. So what I like to do is to spend a little time to the people that are not yet utilizing our services. And I'm going through some of the disclosure information that we have to provide when we do a webinar like this. And there's definitions in here as well. But let's look at a little bit of what we do here at the firm. So Michael already talked about how we focus around our lifestyle goals and what's important to our clients. And we all build this, and we build this whole philosophy around form and what's important to you. That's what drives the entire process that we work with and what we call our life wealth plan. And as Michael talked about earlier, what we're trying to address with our clients is how do we enrich your life by managing and attacking, I guess, for a better word, any impactful financial events that you have coming up. Okay. And it could be a number of things, as you see down here, that are listed. And what we want to make sure is that we're keeping top of mind all of these different events when we're doing the planning, so that when we get into a scenario where we start looking at your investments, how does that investment piece of your portfolio affect your estate plan and the legacy that you want to leave behind? Okay, so these are all intertwined, even though we have them on a linear line when we're going through our planning process. So there's a number of different scenarios here that we always want to look at: bull markets, bear markets, elections is something, retirement tax law changes over here on the right. So what we've come up with is a cadence. This cadence allows us to really address kind of all these impactful financial events and try to make sure that nothing falls between the cracks. Okay. Here's really one thing that makes us quite a bit different than other firms that are out there. It seems like everybody knows a financial advisor, right? I mean, I know somebody who works at X, or I know somebody who's a financial advisor. Okay. Our process is what makes us different. Our process is what distinguishes us from other people. And it also is a disciplined process. And so this might be a sort of scenario that a current client or a new client would go through. Okay, let's in quarter one, let's focus on the priorities of we need to do some tax planning and we need to look at the investment management. So everything is based on the priorities around your form goals. And then we break that down into different installments, if you will, of quarterly conversations and quarterly planning where we go through this. And then we repeat it over and over and over again, year in and year out. And that's why we have some clients that have literally been with us since I opened the doors up almost 30 years ago. So we try to never lose sight of what's important to you. And we do that by having a discipline around how do we plan according to these quarterly topics. So that's what makes us quite a bit different than quote unquote financial advisors that are out there. And I say quote unquote because if anybody saw the Wall Street Journal article that was this weekend, it's about a Minnesota couple that won the Powerball a number of years ago. I think it was about 12, and they invested it with a financial advisor. This couple they were solid people. They started a 503. They wanted to create an organization that could do medical research to help kids because they had a tragedy in their own family. And this advisor put all the money into high expenses type of investments that just couldn't generate much return because the investments costs were so high. Okay. We combat this with our own investment strategy, which really is geared on let's keep the cost in line and low and competitive. And let's look at the environment, everything that we've talked about, and build portfolios for our clients that meet their form goals, meet their risk tolerance. And then let's layer in areas of the market that we think are going to be stronger than other areas of the market. Okay. And the key word is there is think. We don't know for sure, but we do own semiconductor stocks as an example. The thing that's interesting about it, we didn't jump on the NVIDIA bandwagon, this past year. We've owned that in portfolios for over 3 years. We own the other areas of the market that we think are strong. And when we get together as an investment committee and we're looking at your foundation of dividend paying, usually ETFs, and we're looking at your bond portfolio, and we're looking at innovative companies and dominating companies. We also are looking at where is there some opportunity. We heat map it. The red ones and the blue ones, distinguish which ones are hotter or colder. And then we tried to anticipate what would make sense in our clients' portfolios. So when Michael was talking about home builder stocks, we own an ETF that has home builder stocks in there. And we own typically about 4 different areas in there, as well as this foundational approach. And this investment committee, again, isn't an advisor who's sitting at a desk trying to figure out what he should be or she should be buying for you. It's led by a group of 7 people on a team that get together and review this on a regular basis. And we have over 200 years of experience doing this. And it's dedicated to us doing a better job planning for our clients. Okay. And the other thing that makes us a little unique for the people here that don't know us very well, this is a team approach. I don't know if anybody on this webinar has gone down to Mayo Clinic. Okay, I have. I go down there every year for my physical. And the thing about the Mayo is it's a team approach. Right? They deliver the best healthcare in the world via a team approach. So our approach is very similar. At least that's the way I've built it. We've got a team, and then we have specialists in the different areas. Brian, for example, not only sits on our investment committee, manages the Elk River office, but he's an insurance expert, and he's our specialist in that. So we need to look at risk for our client. We bring Brian into the picture. Will advisors change? Absolutely. My doctors down at Mayo change. But what I know is everything is kept in one area, one portal. We call it the Life Wealth Plan portal. And we can bring specialists in as needed and continue relationships as needed because we are basically mimicking the Mayo Clinic healthcare team approach. And I think it works pretty well in the wealth management as well. Okay. Great example of that. We own a tax firm as well. Part of that, Joe Rapakian, the Rapakian Company over in Edina, can help us integrate tax planning and tax strategy and tax preparation into the life wealth plan. Okay. So between all of this, there's lots of checks and balances. We have lots of people working in our client's best interest. We serve as a fiduciary. Frankly, we can't do anything that would be overly aggressive or overly erroneous to somebody because we do have these checks and balances. And that provides a better, we hope, outcome through this life wealth process. And the process is real simple. We get together and we see, can we provide value to your life? Are we a good fit for each other? If we are, we move on to this get organized or go meeting. And that is where we start gathering your income tax returns so we can do an analysis of that. We gather your investment statement so we can analyze how much risk you're taking with that. We analyze your insurance to see if you have the right amount, if you have too much or not enough, if you have the right kind. And then we put together an implementation plan and we set that thing in motion and we watch it over and over again so that we make sure that it's aligned to what your goals are. And it's all a team of 25 people that are here to act in our client's best interest. And again, makes us different from that person that was putting high cost investments into a nonprofit organization that the Powerball winner was setting up for their in memory of their granddaughter, because you have different people in different areas, just like you would at Mayo Clinic, who are all there to help you achieve your goals. So if this sounds of interest to you and you've stuck around with us, I hope it does at this point. Schedule a call, 15 minutes. You can learn a little bit more about the process. We can learn a little bit more about you. We'll see if there's a good opportunity to work together and we can bring you some value. We'll go through our fee structure. It's very competitive and we provide a lot of value to it, but give us a call and we can get that scheduled with one of our advisors. So with that, Cameron, do you want to bring us home and talk a little bit about anything here at the end?
Yeah, thank you for your time today, everybody. We will be emailing out a recording of this entire webinar, as well as I encourage you to keep your eye out at your email for any upcoming webinars this year. With that, that concludes our program. So if you're interested in speaking with Mike, Michael, Brian, a 360 Wealth Manager, we will be reaching out with a scheduling link, and you can go online to set up a brief introductory conversation.
Thank you, Brian. Thank you, Michael.
Yeah.
Thanks, Cameron, for stepping in as our intern. We appreciate that as Trony's off to Norway for a little vacation. And we look forward to talking to all of you on this webinar, whether you're clients or your potential clients, about your form goals and how we can help you achieve them. So thank you.
Have a great day, everybody.